Salesforce stock cut directly in half. Adobe down 40% from its absolute high. Workday, Snowflake, MongoDB, Okta, all of them bleeding out on the pavement. The entire software as a service sector has just been taken out behind the woodshed and beaten to a pulp. 5 years ago, back in 2021, these were the untouchable market darlings of the entire financial universe. You could not buy them because they were so ridiculously expensive. And today, they are being tossed to the side of the road like absolute garbage. Wall Street is completely convinced that artificial intelligence is about to finish them off for good. So, here's what I want your brain to consider before you hit that panic sell button. When Mr. Market panics this loudly about this many massive companies all at once, he is almost always doing one of two things. He is either correctly pricing in a literal death sentence, or he is handing long-term investors the opportunity of a decade. In this video, I am going to show you the one exact question that separates these two scenarios, and I am going to walk you through a real example that is trading on the market today where the numbers are frankly hard to believe. So, let us talk about it like grown-ups over a cheap dollar coffee. Now, before we touch a single individual stock ticker, you need to understand something most retail investors get completely wrong. Not all sell-offs are created equal, you guys. There are three completely different kinds of market sell-offs, and they each demand a completely different emotional response from you. Type 1 is a company-specific sell-off. This is when management completely blows a major strategic decision, growth stalls out, or real fraud surfaces. What happens is the stock drops, and the drop is usually completely deserved, because the underlying business is actually worse than it was yesterday. For the long-term, Type 2 is a market-wide sell-off. This is when macro interest rates spike up, a major bank fails, global liquidity completely evaporates, and everything gets repriced at the exact same second. So, the good, the bad, the ugly, it all goes down together. And these are the exact moments Warren Buffett lives for, because great companies go on a massive discount sale right alongside the junk Type 3, which is the exact chaos we are sitting in right now, is an industry sell-off, not just one single company, not the entire macro market. But one entire specific industry is repriced, simultaneously because of a major shift in the narrative of that industry. Industry sell-offs, in my personal opinion, are the most misunderstood events in the history of investing. Why? Because in the middle of them, the market completely stops being precise about the actual value of these businesses. Uncertainty is running rampant, and institutional investors on Wall Street cannot yet tell who the winners and losers will be. So they just panic and dump every single thing in the sector. They dump the best companies, they dump the worst companies, they are all treated exactly the same. And that total lack of precision, that is exactly where the massive wealth opportunity lives. Right there. That is where the gap between price and intrinsic value can blow wide open in the absolute best businesses in the industry. But you have to know exactly what to look for. So right now, software is absolute ground zero for this panic. Artificial intelligence has created a massive wave of existential uncertainty across every single SaaS business on the market. Investors are asking, will AI completely replace this product? Will the corporate pricing model collapse? Will the revenue growth flatline forever? And rather than answer those questions carefully, one company at a time, the market is just selling everything with a ticker symbol. So here is the one question, the one I promised you up top. That will tell you whether each of these fallen software stocks is a trap or a treasure. Is this technological disruption structural, temporary, or irrational? Now, that distinction is absolutely everything. If you want to protect your capital, structural means that the long-term earning power of this business is permanently lower. The competitive moat is completely broken. The product is going to be replaced by something better and cheaper. So think about Kodak when digital cameras arrived. You probably do not even remember because you are too young. When digital cameras arrived, that was not a temporary dip in Kodak fortunes. That was a literal funeral for their entire business model. It was a permanent structural change. And when that happens, Mr. Market is 100% right to punish the stock. And a lower price today will still look incredibly expensive a year from now as that company continues to decline into zero. Temporary means the fear is real, but the moat is actually fully intact. In other words, revenue and quarterly earnings will take a quick bruise, but then they are going to fully recover. The company will come out the other side of the storm even stronger with weaker competitors completely wiped out. So think, for example, about Texas Roadhouse during the pandemic in 2020. These physical restaurants were completely closed. The revenue completely disappeared, the stock cratered to the floor, and anyone who understood their massive brand moat made a total fortune as the stock rocketed from $35 all the way to $200. Now, the third one, irrational, means Mr. Market fear is based on a pure emotional overreaction to something brand new in the industry. Netflix stock absolutely tanked from $66 down to $19 when Disney and Apple decided to become streaming platforms. And then we got into a major macroeconomic meltdown. Then it just turned out the new streamers really did not matter to Netflix dominance. And the stock shot straight up to $120. And that is exactly where I think we are right now with Salesforce. Your entire job as a Rule 1 investor in this exact moment of AI entry into the SaaS industry is to sort each software company into one of those three buckets. Did AI cause a structural, a temporary, or an irrational repricing? thing. You get that one judgment right, and you do not need to predict the future of AI. You just need to recognize a durable, long-term moat when you see one. So let me make this concrete for you. I want to walk you through one specific company in this wreckage, not as a financial recommendation, you guys, just as a real-world example of how to actually think about cash flow. So here is the basic setup. Salesforce. Salesforce is the ultimate system of record for how most of the developed business world manages its customers. Sales teams are tracking massive corporate deals in it. Marketing teams are running millions of digital campaigns out of it. Customer support teams literally live inside it every single hour of the workday. If you are working in a mid-size or large global business, your company revenue engine probably runs one way or another directly through Salesforce. Now here's the dominant fear on Wall Street. Analysts think AI agents will eventually match what Salesforce does faster, better, and significantly cheaper. Or at a bare minimum, AI will completely collapse the number of human seat licenses that enterprise companies need to buy. Fewer human licenses means much lower revenue, which means totally crushed corporate earnings. Now, that is the bear case, and it is not completely crazy on the surface. But here is what Charlie Munger would tell you if you were sitting here. Always invert the problem. Instead of asking how could Salesforce win, ask what would it actually take for Salesforce to lose, to actually kill their business completely. Well, to kill it, an enterprise customer would have to willingly rip out the central nervous system of their entire global business operation. They would have to migrate years. Sometimes it is literally 2 decades of highly proprietary customer data. They would have to retrain tens of thousands of corporate employees on a brand new system. They would have to completely rebuild every single software integration across their enterprise. And they would have to trust that a brand new AI agent, the kind that might hallucinate or stall or randomly drop a customer record here and there, they are going to just replace that with information that their entire corporate revenue depends on. Well, picture yourself right now as a VP of sales who championed that massive infrastructure switch. And what is your actual upside if the switch works perfectly? You have modestly lower CRM software costs on your quarterly budget. What is the actual downside if it fails? Oh, well, you completely blow your quarter, you blow your fiscal year. Maybe you blow your entire business continuity, and for sure you get fired on Monday morning. Now, that is a massive switching cost, and that is the definition of a durable economic moat. And moats built on deeply embedded corporate workflows, those do not just crumble in 12 months because a new technology arrives on tech blogs. At the absolute worst case scenario, they tend to slowly erode over like a full decade, if they even erode at all. So here is the massive financial disconnect. The part I said earlier that was really hard to believe, right? Since its 2024 highs, Salesforce stock price has been cut exactly in half. The price earnings ratio has compressed from a sky-high 100 all the way down to a modest 22, a 22 PE ratio for a dominant tech giant. What that valuation implies is that Mr. Market is expecting this entire business to grow at maybe 10% or 11% a year going forward into the future. But let us actually look at the hard financial numbers from last year. Their earnings grew by a massive 20%, operating cash flow grew by 16%, free cash flow grew by 15%, book equity plus grew by 15%. So let us think about that. It is currently priced for 11% growth or worse on a business with an incredibly deep, expensive switch moat that is actually growing its cash flows at 15 to 20%. Now, that is exactly what a real gap looks like between market price and intrinsic value during an industry-wide sell-off. And that is Mr. Market smelling fake smoke in a crowded theater that isn't actually on fire. And all the panicked Wall Street lemmings are trampling each other running for the exit door. Now, very important, hear me clearly on this. I am not telling you to go out and blindly buy Salesforce stock today. That is not what this video is about. That is not what we do on this channel. There are still highly legitimate questions about how AI reshapes the broader CRM industry in the next 10 years. And you should take the institutional bear case incredibly seriously. Charlie Munger said it so beautifully. You must know the opposing argument better than the actual people who are making it. And that is the #1 way you avoid losing your hard-earned money in the stock market. What I am telling you is this. When an entire industry gets completely repriced because of pure narrative fear, your job is not to run blindly with the herd. Your job is to look at each individual company inside the smoking wreckage and ask 3 precise questions. Is the competitive moat fully intact, or is it breaking down? Are the underlying financials still incredibly strong, or are they deteriorating? And is the current stock price now sitting well below what the business is actually worth in cold hard cash? And when all 3 of those things line up perfectly, you get a real economic moat, really good historical financials, and real psychological fear dragging the price down. That is when you lean in. That is when you do the hard spreadsheet work and you make up your own damn mind. God, that is so incredibly key to this whole game. Because as Warren Buffett and Charlie Munger have said many times over the decades, Wall Street can make literal witch doctors look highly competent. Their institutional opinion is not automatically better than yours. In fact, since you have the luxury to think in 5 to 10 year periods, even full decades, and they can think only in 90-day fiscal quarters, you have a massive structural edge in moments exactly like this one. Look, you guys, in moments like this, an entire high margin industry goes on a massive garage sale and nobody can tell the winners from the losers on Wall Street because they are blinded by panic. And that is exactly why the Rule 1 value framework exists in the first place. This is exactly when it earns its keep and saves your portfolio. If you want to learn how to properly read a corporate moat or how to pressure test a balance sheet, how to accurately calculate what a business is actually worth based on future cash flows, how to set your margin of safety buy price with total confidence, or how to use options to begin creating immediate cash flow. While you wait, that is exactly what we teach in our 3-day online workshop. Over 30,000 real students have now come through it, so do not take my word for it. Take a look at our 4.8 Trustpilot score online. The feedback has been absolutely incredible, you guys. And if that sounds like the exact skill set that you want to have in your investing tool belt when the next industry sell-off shows up, because trust me, there's always a next one coming. Check the link in the description below or scan the QR code right now on the screen. And thanks for watching, you guys. Now go play.